Guys, welcome back to the Independent Investor Channel. My name is Ryan. This is gonna be the tug of war that I'm observing on YouTube. It's amazing, man. I have to laugh, man. I really do. A lot of you guys know, man, when I came out with the Independent Investor Channel a couple years ago, man, it was one of those things where I wanted to get my message out there. All right, I knew I was right. I still to this day know I'm right. I validate it every single day, and I've got a great subscriber base doing just that. But here's the funny thing, and I just sit back sometimes, and I offer this video honestly for clarity for my subscriber base. Honestly, if there's other channel creators that come on there, they're going to get a laugh and a kick out of this, honestly. But the tug of war is really interesting, man. And I sit back and I have to laugh, man, when I've got certain folks that are like, you know, you have to invest this way, man. You have to, man. Anybody who doesn't invest this way is stupid, man. You know, you should feel stupid, man, if you want to buy, let's say, like a dividend stock. You know what I'm saying? Or you should just be looking for growth, man. You should just be looking for these specific criteria, and you should invest this way. I can't really tell you why, right? Only other than the fact that this is the way that I invest, right? And this is why I'm so transparent on how it is that I invest, because you've got certain folks saying, you know what, if you're not a dividend investor, you need to be a dividend investor. And if you don't have dividends, you need to get some dividends, man. You've got to get some dividends, and you got to pick up those stocks at the absolute right price. Could be right, could be wrong. I've been doing this gig for a long, long time. And I've come out with videos on my Chronicle, that of which when the channel wasn't really that popular at all. Hell, we're still a fairly small channel, and I'm totally cool with that. But I talked about speaking in definitives, all right? And talking along the lines of, you can't buy Coca-Cola because it has a high PE ratio. Now, it's scoffing to the fact that it's doubled over the last 10 years for investors who have held the stock. There is no acknowledgement whatsoever at the lack thereof of risk that is necessary to take on when you invest in a fine company like Coca-Cola. But we'll put that aside for just a second, all right? The real tug of war becomes getting involved with a certain perspective or philosophy on the stock market. You want to know the secret from my perspective? 25 years in the stock market, I've been doing this. You know, you want to know the funny thing about this tug of war, virtual tug of war on YouTube? Everybody really cares about their particular method or approach to the stock market, right? Because if you are involved and you do some research on the stock market, it's an arena that you can succeed at, all right? And I'm going to kind of just throw this out there for anybody that's listening, whether it be you a subscriber or you're a new investor. And I'm going to get to the new investor at the final at the end of this video, all right? But if you're a channel creator out there and you're pushing, you know, one particular method or another method, the funny thing about it is you're all right, all of you, all right? Because I see all the time this tug, this push-pull of, hey, my program's right, and hey, my program's right, and hey, your program's wrong, and your program's wrong because of this statistic, or your program's right because of this statistic. The funny thing about it is you're all right in that philosophy and perspective. The problem is you're all wrong as well, all right? You really are. And here's why. You tend to try to push out, you know, what it is that's worked for you, all right? And in its totality, your particular program, whether it be a dividend pillar in your portfolio or whether it be a growth pillar in your portfolio, it may be appropriate to have a higher than average risk level for somebody that brings in $350,000, $400,000 a year, right? It doesn't mean that that's appropriate carbon copy across the board, especially for people who, if you're a subscriber and you're sitting there and you're rubbing your $100 together and you're just looking for some answers as to what stock to buy, you know, should I buy growth? Should I buy value? Should I buy passive? All right? You're all right in essence, and you're also all wrong in the perspective, all right? So many people want to talk about growth, growth, growth. It's the sexy, it's the next best thing. It's the ones that are putting up triple-digit growth, right? 4-digit growth, right? It's your NVIDIAs, it's your Netflix, right? It's your higher than average growth companies out there, man, with high multiples. Amazon, right, is in that category. It doesn't mean that those investments from a growth perspective are appropriate for everybody. And certain people want to look at a company that falls into the value category, like let's say a Procter & Gamble or a Coke, and say, that just doesn't equate. It's because you're trying to compare apples and oranges. That's why. Furthermore, if you're recommending growth because it's appropriate for you, it does not mean that it is appropriate for everyone out there, okay? It doesn't mean that an Amazon is appropriate for somebody that's 57 years old, has a risk tolerance of 3 or a moderate risk tolerance, who's got retirement around the corner and just wants to buy some safe dividend-paying stocks. Now that is the explanation and the justification for putting somebody into value over growth, all right? Consequently, if there's somebody out there who is young and can take on the risk of a growth name like an Amazon or you know, any of the growth companies out there, Netflix, these are great companies, guys. They're great, and that's why I say I watch the YouTube community when I can. All right, and I just it's amazing to me the push-pull of you're wrong and I'm right, and that's just the way of it. Follow me or die. You know what I mean? It's amazing to me. Like, the stock market does not allow you to be definitive in that nature. It doesn't. It requires you to be holistic and open-minded. It requires you. Otherwise, you'll get humbled if you end up relying and building your house on one particular pillar. It really will. All right? The last piece here is passive. All right? And I require or recommend that anybody that's zero for $10,000 in the stock market go with a passive approach. That's my recommendation to you guys. What gets missed all the time in this tug of war, either growth or value, or this is passive. Anybody who does ETFs is stupid. You shouldn't be doing any of that, right? It's the constant tug of war. Dividends, value, growth, whatever. Right? And again, the beginning investor is just sitting there waiting for an answer, right? It's amazing to me, and I laugh. It's straight up surface level entertainment for me, man. It's like investing 101, honestly, if I'm giving enough credit for that. But the tug of war between growth and value can only be determined when you take in these 3 factors. It is age, it is risk tolerance, and it is in line with your financial goals. All right? Investing in an Amazon or selling an Amazon or holding shares of Amazon is only appropriate when you take into consideration someone's age or risk tolerance to the stock market. All right? If somebody comes to me and says, you know, I'd like to invest, I've got a little bit saved up, I've got some savings aside, I'd like to build a few cornerstones in my portfolio of some good dividend payers, I'm not going to hear that out and then say, nope, you can't invest in a dividend stock because well, number one, I don't do it, therefore it's stupid, and I don't know anything about it, but I'm just going to say that you might as well go for higher than average growth. Well, hold on a second, man. I was just speaking English to you and just told you that's not really what I want because it's not in line with my age, risk tolerance, or my financial goals in the future. Perhaps maybe you just want to put some dividend higher than average blue chip companies in a nice tax deferred account and let those grow over time to maybe leave an heir to your children. What are you going to do? You're going to leave a bunch of growth names for your children that may or may not be in business 10, 20, 30 years down the line? Think about those things. These are the factors here that play into it, man. Your age, risk tolerance. And a lot of folks, unfortunately, are young and they can absolutely justify, based on their age, going with a high growth name. And that is the sexy stuff, man. That's what's being pushed out. That's what people want to hear. When you're 18, 19, 20 years old, 18 to 24, man, that's the sensitive bracket right there that should be doing this, but they hear this and they jump on board. Because they got the dollar signs in their ears, man, in their eyes, and it's like, oh my goodness, I'm on board, man. This is unbelievable. This YouTube individual must know what they're talking about. I trust and I go, right? It's blind faith, man. I put it on and I jump because this person says that this is the way I invest and therefore it must be good for me. The ironic part about that is somebody that has the age, should be taking advantage of the very ace up their sleeve that they have, and that is time. That is time. As long as we can get them into the stock market correctly, they don't have to be screwing around with taking on an unacceptable level of risk at this age. Now, there is an appropriate level of risk to be taken when you're young, but not inclusively, not all exclusively in risk. That's absurd. That's absurd. All right? The risk tolerance has to be taken into consideration. And if you can tell me at 18, 19, 20 years old that you have the appropriate risk tolerance to enter into an all-stock portfolio of all growth, come and talk to me in 6 months, man. Come and talk to me, and we'll get you squared away, because you will have done what so many other people have done before you, and that is jump in, cut an artery, have to have surgery, and then come back and say, Ryan, you were right. You were right. I should have defined my level of risk by entering into the stock market as a passive investor. All right? Now, remember when I talked about these YouTubers out there, you gotta buy dividends, man. You can't buy AT&T. You can't. It's impossible. It's not cheap enough. You know? The tug of war, back and forth. The funny thing that is missed, and I say this all the time on my channel, I'm fairly certain that I'm speaking plain English. When I said that all the creators who are looking to present what it is that they've had via success in the stock market, whether it be through dividends, because dividends is a solid way to make money in the stock market, value investing, blue chip investing, and high dividend payers, dividends companies that have paid back stockholders for years. Growth investing, seeking out a higher than average appreciation within your portfolio, that is also a sound way of investing. And finally, the passive way of investing. That is also a way to set a barometer within your portfolio to make sure that you are capturing all of the appreciation and capturing all of the depreciation in the stock market. It's basically your barometer within your portfolio. These are all important, all right? But the thing that I find, honestly, the most appalling to me from my perspective, and this is for my audience, who tunes into me and trusts the decisions and the really my assessment of the landscape on YouTube. And this is really why a lot of people don't come to YouTube to get their financial advice. It's more for entertainment than anything. Is the fact that if these are all right, how can they all be wrong? Okay? And what I find all the time glazed over is if you choose a growth program, or if you choose a value program, and if you choose a passive program, and you say, Ryan, you're right. God dang it, I fought for so many years and I just told everybody that they had to go here because that's what I did and that's what kind of works for me. It really doesn't, but that's all right. It sells a lot of videos to people, right? It sells a lot of videos, but I hear you, man. You know, maybe somebody who's young and says to me, I don't really want to buy growth. Maybe they shouldn't buy growth, right? What gets missed all the time is to make sure that whatever your program is, based on your age, risk tolerance, and the goals that you set in the future for yourself, are to make sure that the assets are housed in the correct bucket. All right? The tug of war on the YouTube landscape that I find all the time that is crazy is you've got to do this program. You've got to buy this stock to initiate this program. This stock has to be bought, and you're stupid for doing this program. This and this and this and this. And all the while, the major piece to the equation is not being talked about, and that is the bucket. The account that these assets, irregardless of whether or not you win the war of tug of war, right? And you can prove to somebody that they need to be a 100% growth investor, what account are they going to house those assets in to grow tax protected and wealth preserved? And guys, I just in one sentence gave you the niche of the Independent Investor channel, and I push it out there all the time. And I know I've got other channel creators out there that listen to my message and it goes whoop right over the top of their head. Right over the top of their head, because I'm the only one that talks about it, man. I am the only one that talks about it. Guys, thank you so much for tuning in. If this is your first time tuning into the Independent Investor channel, man, you want to hit the subscribe button. You'll be notified of all the future videos that I push out there, man. Doing daily uploads, getting the message out there on the empowering message, man, of whatever age you are, whatever risk tolerance you are, whatever style of investor we look to evolve you to becoming, to make sure that you are exploiting the benefits of protecting those dollars that you're eventually going to make through tax protection and wealth preserving those dollars, man, through eliminating or drastically reducing fees within your retirement account. Guys, leave your comments at the bottom if you feel like I've hit on the nose here. If you disagree with me, leave those comments at the bottom. And finally, share the message with anybody out there that you know that is looking to get involved in the stock market. If you'd like them to get involved in the stock market correctly, tune them onto my channel. If they're really good at tug of war, send them out in the landscape of YouTube. I'm sure they'll have lots of fights to fight and a lot of tug of war battles to have as a beginning investor. Guys, thank you so much for tuning in, and good luck in your investment future.